Here's a draft for a 10-minute article's video script on what might qualify as a best cheap stock in America and why someone might consider buying it, with caveats. I'm not endorsing this as financial advice. Treat this as a starting point for your own research. What do we mean by a cheap stock? A cheap stock often, but not always, refers to a company whose share price is low, for example, under U5 to 10. Investing.com. But price alone doesn't tell the full story. More important is whether the stock is undervalued, i.e. trading below what the company is likely worth if business fundamentals improve, earnings, assets, growth potential, etc. CNBC.com. This style of investing, buying value or undervalued stocks, has been advocated for decades by value investors who look for bargains the broader market overlooks, CNBC.com. So a cheap stock may be cheap because it's genuinely undervalued, or simply cheap because the company is weak or risky. The challenge is to distinguish between these cases. Example, a recent cheap stock under spotlight. Here's one real example of a cheap price stock that some screeners are at around US $5.36 per share as of now. According to a recent list of best-performing cheap stocks, UAMY was among those under $10 that delivered very high year-over-year gains. NerdWallet.com. What's attractive? Low entry price. At just a few dollars per share, you get more shares for your money than with expensive blue-chip stocks. Potential for high upside. Small price, small cap, undervalued companies can occasionally deliver massive gains if the market re-rates them or if business turns around. Affordability. Allows small investors, even those with limited capital, to experiment without putting large sums at risk. Risks, and why cheap can be dangerous. Cheap often means volatile. Stocks like UAMY or others under $10 may swing wildly, up or down, which can lead to large losses if things go wrong. Nasdaq.com, low liquidity, fewer buyers-sellers, which means it might be hard to sell shares when you want. StockMindsweb.com, lack of transparency and risk of fraud. Many ultra-low-price companies have weak disclosures, and pump and dump, hype-driven schemes remain a real danger. MarketBeat.com, price per share, company value. A low share price does not guarantee a good deal if underlying fundamentals, earnings, debt, business prospects are poor. InvestingAwards.com, long-term growth might be limited or negative, and cheap stocks can end up being value traps rather than hidden gems. Fool.com, why some investors still buy cheap stocks and what to watch out for. Pros, high reward potential. If you get in early before a turnaround or before wider recognition, small-cap cheap stocks can yield outsized returns. Low cost of entry. Good for small investors or first-time stock market participants. Flexibility experimentation. Because the monetary commitment is small, you can afford to take risks or diversify across several cheap stocks instead of concentrating on a few expensive ones. Cons. What makes cheap stocks risky? Volatility and unpredictability. The swings can be substantial. What goes up fast can crash just as fast. Liquidity risk. Hard to exit a position cleanly, especially if the stock isn't widely followed or trades thinly. Information gap and transparency. Hard to reliably assess whether the company is healthy, stable, or on shaky ground. Manipulation and fraud risk. Sub $5 or sub $10 stocks are sometimes targeted by pump and dump schemes or speculative hype. Lack of institutional backing. Big investors, mutual funds, pension funds, often avoid such risky small caps, which reduces stability and makes price swings more extreme. Value research online. Because of these cons, many financial advisors caution against betting the farm on a bunch of cheap stocks, especially if your objective is long-term growth or stable returns. Fool.com. So, is there really a best cheap stock? Or is the idea misleading? Probably both. The idea of a best cheap stock can be misleading because cheap doesn't necessarily mean good value. The smaller and cheaper a company gets, the more risk you take on, but also the more you stand to gain if things go right. A best cheap stock, if it exists at all, must be picked very carefully. You want a company with at least some track record or business fundamentals, or credible potential, not just hype or speculation. You want to understand why it's cheap. Is it undervalued, or is it cheap for a reason? Bad management, financial trouble, declining sector. You want to accept that you may need to tolerate high volatility and possibly multiple failures. Spread your investments, diversify. In other words, hunting for cheap. Stocks can be part of a smart value investing strategy, but only with discipline, research, and risk awareness. How